Hey guys, Tony here. Just a very quick summary recap of Cinemark's Q2 2024 earnings for those of you who didn't listen into the live earnings call with us on Friday morning. And the main thing I want to hit on this video is to the people that are wondering, why is AMC struggling and Cinemark is going up? So we're just gonna talk about at a very high level what is going right at Cinemark. And if you are in that position of wondering why is one cinema company doing well and the other struggling, I urge you to subscribe to the channel, follow the content here, learn how Wall Street evaluates financial statements. I'll teach you the basics of what to look for on financial statements, what type of analysis matters for analysts and institutions to get behind a stock and set a price target. And at the end of this video, I'm going to give you my price targets for Cinemark for 2025 and 2026. The next video that I'm going to put out for you after this one will go through the same basic information for AMC. And if you guys want to see it, if you want to see a side-by-side comparison of operational metrics of Cinemark versus AMC, I'm happy to do that for you too. Let me know down in the comments. I will only take the time to do that if I get a bunch of people in the comments saying that you guys want to see that kind of comparison. With that being said, let's go through the Cinemark numbers really quick. I wanted to start off with the dashboard that I use to give you guys a pictorial analysis of how I view the risk of a stock. There's a lot of common things here that Wall Street and professional traders use to do a baseline analysis. This is just very simple, high-level stuff for somebody who has no idea how to analyze a stock. This is the same criteria I use for every company that I analyze. So it is non-emotional. There's no bias. It's just red, yellow, green based on certain values for each box. When you're buying a stock, I want you to do a lot more analysis than just something simple like this. But for those of you doing a drive-by in a 3-minute video, this gives you a red, yellow, green. Where are we at on this stock? Very high level stuff. Cinemark still has some yellow on here. It's not a all green stock. So let's talk about the yellow and red. Return on equity, negative 30% over a 5-year basis. If we look at trailing 12 months, though, they have a 40% return on equity. So depending on what time frame you want to look at, you could color that green or red. Debt to equity ratio for Cinemark is still high. That box is yellow, but they are taking active steps to further reduce the debt on their balance sheet. And there's been a lot of activity in the last month or so as they've been taking some steps to pay off debt, refinance debt, push some of it out. And they talked about their further plans over the next year or so to continue to improve that debt on the balance sheet. The revenue growth rate for Cinemark went from green to yellow this quarter. As you guys probably know, there was a actors and writers strike in 2023 that affected the first 2 quarters of 2024. So all the cinema companies in Q1 and Q2 2024 are struggling with quarterly numbers that aren't as great as we would like them to be. But that is now behind us, we think, for the industry, and things should be getting a lot better from this point on through 2026, at least, based on what we know. The dilution box, they have some convertible debt on their balance sheet, but based on what I heard management finally talk about on the earnings call on Friday, I moved it to yellow. Basically, what they said is they plan to pay out those convertibles in cash and not actually let them convert. So we'll have to keep an eye on that. There is still some dilution risk, but if they are planning to pay it off with cash, then we don't have to worry about that. The short interest is still very high on Cinemark. It might seem odd to anyone watching a company post positive earnings with a bright future ahead in terms of box office have such a high short interest. And the only thing that I can think of why their short interest is so high might be some arbitrage going on with those convertible notes. We will see how that works out over the next quarter or two. Dividends I have marked as yellow because they're not currently paying a dividend. That's not a plus or a minus against them. But on the earnings call on Friday, they did talk about once they have some of the debt issues fixed on the balance sheet, they will be looking at additional ways to return value to shareholders, which to me says, you know, I think that we could be expecting at some point share buybacks and or dividends in the future when things get better for Cinemark, not in the short term. Highlights from Cinemark's Q2 results. Positive earnings, 32 cents a share on $734 million of total revenue, which netted $47 million of net income positive. That gave the company a adjusted EBITDA of $142 million positive with 19.4% adjusted EBITDA margin. On the balance sheet, they ended the quarter with $789 million in cash, and management did say that they plan to use some of that cash to further attack and reduce the debt on the balance sheet in upcoming quarters. Cinemark does still have a substantial amount of debt, as we just saw on the dashboard, but they are working on reducing it, as are most cinema companies that have debt. They redeemed $150 million of their 8 3/4 senior secured notes in May, just a couple months ago at par. They repriced a term loan, reducing the interest rate by 50 basis points, and they issued $500 million of 7% unsecured notes due 2032, which is going to replace some debt that they had coming due in 2026. We see that a lot with movie companies right now. They have debt coming due in 2026, and they know that things are going to get better in the next year or two, so they are pushing that obligation out, giving themselves more breathing room. Going over to their debt table in the 10Q, how do these bullets align with that debt table? You can see the green item is the 8 3/4% notes that now have a zero balance. It was $150 million in December of 2023. The blue item is the term loan where they reduced the interest rate. There's $641 million due in 2030. And the yellow item is the $405 million of notes that was due in 2026. They tendered an offer to those note holders to buy them back. Got about an 85% participation on that, and they are replacing those with some new notes with a much later maturity date. Now, if you are wondering about that top line item, which I just highlighted in pink, the 4.5% convertible senior notes, $460 million. That was what I have highlighted in the dashboard as potential dilution risk. What they told us on the call today is what I have in red text at the top of the screen. They said that they intend to leverage the cash on hand to repay the $460 million of notes when they mature in August of 2025. So that is the current message from management on what is going to happen with those notes. Cinemark is currently trading at $24.85. And as we look at the analyst forecast, they have it rated a buy, but the average price target is $22.64 with a recent upgrade on Friday. One analyst given a target of $24. The highest analyst target is $27. So we're really close for the next 12 months of where analysts think Cinemark is going to be headed. And that is something to think about if you're thinking about buying Cinemark. We'll talk about my 2025 and 2026 estimates for price target in just a minute. But I want to go over with you guys, why are analysts, I see you out there asking, why are analysts giving such high price targets to Cinemark, and why is the price going up while AMC is struggling? Let's just talk about 2 or 3 things that analysts look at to give these price targets and why Cinemark is going up. Whatever stock you're looking at, be it Cinemark, AMC, GameStop, you name it. If it's a meme stock, you need to look and see, does the company have positive earnings? Does it have a long history of positive earnings? And is there a forecast for positive earnings? Because that is what Wall Street is going to be looking at to get behind the stock, be it an analyst giving it a good price target or institutions coming in and starting to buy the stock and pushing the price up. You can see here on the chart, Cinemark now has 4 of the past 5 quarters with positive earnings, and that is important. I don't want you to underestimate the importance of positive earnings to get a good analyst rating and get institutions behind the stock. And speaking of earnings, I think one of the most common mistakes I see people make is assuming that 1 quarter of positive earnings is going to turn the ship around as far as how Wall Street looks at the stock. Really what they're looking at is, what is the long-term outlook for your company? Okay, you booked a quarter of positive earnings, or you barely booked a year of positive earnings with a couple pennies for the year. Is that enough to justify the current price? What is the outlook for the core business over the next year or two? You can't just rest your laurels and say, well, guys, we booked 6 cents positive for the year, we're worth 40 bucks. It does not work that way. And the analysis needs to be weighed. How do those earnings stack up at a PE ratio comparable to peers out in the industry? And then you can start thinking about, based on that PE ratio that is common for your peers in the industry, does the price make sense? And GME folks, yes, I'm looking at you with this little talk here. The other thing that I see just very quickly, and you can do this yourself without being an accountant, go to the balance sheet and look at the current ratio and the shareholders' equity. How do they look? The current ratio is going to be the items highlighted in green here, our total current assets divided by the total current liabilities. At a minimum, we want the current ratio to be 1 or higher, 1.2 or higher, even better. Another way that you could look at these two items highlighted in green, our current assets and our current liabilities, is to look at the working capital. And to do that, you just take current assets and you subtract the current liabilities. And we have here 1.008 billion minus 780 million gives us a working capital of positive $227 million, meaning that the company has more than enough money to pay its bills over the next 12 months. Another simple thing you can look at is the shareholders' equity, which is our total assets in blue minus our total liabilities also in blue. You want a positive number there. Shareholders' equity for Cinemark is a positive $375 million. Once you have a positive shareholders equity, then Wall Street can start doing some real analysis like, hey, this company is not going in the crapper. We can calculate a debt to equity ratio. We can calculate a ROE or a return on equity ratio. If you have negative shareholders equity, you're going to get punished by Wall Street. And if you have positive shareholders equity, they can start doing some real analysis on your stock and give you a real price target. The final thing that I want you to look at, and it's easiest to find it on a summary website like stockanalysis.com, is go to the cash flow statement, go down to the bottom and look at the free cash flow. Is it positive or negative? And Cinemark has a positive free cash flow, and the expectation is they're going to continue to have one and grow their free cash flow as the box office gets better. Whereas when we're looking at a GameStop or an AMC right now, they are still stuck with a negative free cash flow. These are just some basic things that you guys can start looking at to understand why would an analyst want to get behind a stock or not get behind it? Why would an institution want to start buying a stock versus take a wait and see attitude until things improve? There are many more things that we need to look at, but these are a starting point. And I want you guys to get used to looking at them on every play. If you're holding it more than a day or two, you need to know how these things stack up for the company that you're looking at. You don't need to be a CPA. Just know what to look for, and it's very quick. It's very easy. I want you to notice one thing that I did not talk about because it does not matter, but you still hear people talking about it, trying to justify a very high price target for their favorite stock. And we're talking about book value. Book value is irrelevant when you are looking at these stocks and trying to figure out how is Wall Street giving a price target for our stock. You can just throw book value in the trash bin. Book value is something that I don't want you guys wasting your time looking at, or certainly not listening to anyone who's pushing it as something you should focus on, unless the market cap of your company is under book value. Remember when Roaring Kitty was looking at GameStop back in 2020? That was the situation. We're not in that situation with GameStop now, so you should not be looking at book value. Nobody on YouTube should be talking about book value for GameStop. Talk about things that matter, like earnings or return on equity, return on assets, return on invested capital. That is what Wall Street is looking for. And primarily, they're looking for earnings. If you want to know what Wall Street really cares about, it's really easy, guys. Is the top line revenue growing? And is the net income growing? Are earnings per share growing? And can you then apply a reasonable PE ratio out there to get a price? Your baseline analysis can start and stop there, and we need to stop talking about book value because that is misleading people, especially in GameStop. Cinemark has top line revenue, which is expected to grow. They have net income, which is expected to grow. They have positive earnings, which is expected to grow. Therefore, Cinemark is going to be driven up in price. And if we look at analyst expectations for 2025 and 2026 for their annual earnings, we got $1.70 in 2025, $2.10 in 2026. Based on that and just using a industry average PE ratio of about 20, we can say that it would be reasonable to expect a price target of $30 to $32 for Cinemark in 2025 and $40 to $42 for Cinemark in 2026. If the industry delivers the box office that we're expecting and Cinemark delivers the earnings that analysts are expecting based on that box office. Having Cinemark run from the current price around $24 in the next year up to say 33 or 34, if that happens, that's about a 40% gain on the stock price if box office cooperates, right? And so you might be asking, Tony, why aren't you investing in Cinemark? Why are you messing around with AMC? AMC is a much more speculative play, and the company is not yet profitable. But I think that if the box office does grow and AMC gets to the point where they are positive earnings, positive free cash flow, that I have a much higher potential to see returns greater than 40%. Yes, it is risky, so I'm managing my risk. I'm managing the size of my position relative to the risk. And those type of risky plays might not be for you, and that's okay. Make sure before you invest in any speculative stock that you understand the financials, understand the financial condition of the company, and that you have read all of the risk factors in any of the 10Qs or 10K. That is all I got for you today on the highlights of Cinemark's Q2 earnings and why I think the price of Cinemark is going up and will continue to go up. Tomorrow I'll be posting my Q2 review for AMC, including my thoughts on the earnings call, what Adam and Sean had to say. So be sure and check back for that. If you found this video helpful, please let me know down in the comments. If you're new here, don't forget to hit that subscribe button. As always, thank you for watching. I am Tony Denaro, and I will see ya on the next video.